Welcome to Talk Tickers. Today we're breaking down a really impressive third quarter from the water technology leader Xylem. We're going to cover the key numbers, what management is thinking, and then we'll wrap up with our official rating on the stock.
Okay, let's just dive right in. The main story for Xylem this quarter, it's simple, it's powerful, a classic beat and raise. The company didn't just outperform what everyone was expecting, they also boosted their forecast for the rest of the year. You know, this is exactly the kind of quarter that gets the market excited, and boy, was Xylem rewarded for it.
All right, so let's get into the actual numbers that sparked all this positive buzz.
So as you can see, Xylem delivered a pretty significant beat on both the top and bottom lines. Revenue came in at $2.3 billion, well ahead of what the street was looking for. But wow, the real story here is the earnings power. Adjusted earnings per share jumped 23% year over year to $1.37, just crushing the consensus forecast by a solid 14 cents.
And you better believe the market noticed. Right away, trading volume on the day they announced nearly doubled its 50-day average. That kind of surge, well, it signals some serious investor conviction, and it pushed the stock right up to new 52-week highs.
But look, strong revenue is really only half the picture. The really impressive part is how they pulled off these results. This wasn't just about good demand. This is a story about fantastic operational execution and some major margin expansion. The company hit a record quarterly adjusted EBITDA margin of nearly 23%. Now that's a full 200 basis points, or 2 whole percentage points higher than last year. I mean, for a company of this scale, that is a massive, massive leap in profitability.
And this didn't just happen by magic, right? It was driven by a really powerful mix of things: productivity gains, strong pricing, and just more volume. But the key, the real kicker, was their disciplined execution of this 80-20 strategy. The idea is to focus your best resources on the 20% of the business that drives 80% of the results, and it clearly worked, more than wiping out any hits from inflation.
What I found really interesting on the call was how the CEO, Matthew Pine, framed all of this. He said this is just phase one of a three-phase journey. They've already transformed the operating model, and now they're shifting gears into phase two, using that new, simpler structure to really hit the gas on growth. He's basically telling investors, hey, we're just getting started.
Okay, so with that kind of performance under their belts, it is no surprise that management felt confident enough to significantly raise the bar for the full year.
And here it is, the raise part of that beat and raise. I mean, this isn't a small tweak. They seriously cranked up their full-year adjusted EPS forecast, now guiding to a range that tops out at $5.08. And they also now expect total revenue to hit around $9 billion for the year.
And this quote from the CEO, it really says it all. Management is signaling huge confidence in their plan. By raising guidance this much, even while admitting that things are uncertain out there, they're basically de-risking the near-term story for investors. They're saying, yeah, the world's a little crazy, but we've got this.
You know, the analyst Q&A session is always where you get the real color. So we're going to read between the lines on the three biggest questions. Are these margins for real? What are the headwinds? And what's the outlook for their key growth areas?
So the first question on pretty much every analyst's mind was, okay, this is great, but can you guys actually keep this up?
And management's answer was pretty darn confident. They feel like the heavy lifting on the restructuring is mostly done. So now the focus can shift from cutting costs to driving growth. And when the CEO says there's a lot left in the tank, well, that's basically code for this was not a fluke.
Now, it wasn't all sunshine and rainbows. To their credit, management was super transparent about the challenges they're actively working through.
The two main drags they pointed to are a slowdown in China, which they're tackling with some restructuring, and then the intentional move to shed lower margin business as part of that 80-20 strategy. And you got to understand, that second one, that's a good problem to have. They're strategically walking away from junk revenue to boost their long-term profits. That's just smart business.
Analysts also, of course, drilled down on their Critical Measurement and Control Solutions segment, or MCS. This is their smart metering business, and it's a huge piece of their future growth story. So even with some tough year-over-year comparisons, the outlook here is still really solid. Demand is strong, they're sitting on a healthy $1.5 billion backlog, and they expect orders to start outpacing sales again in the fourth quarter. What's driving all this is a huge long-term trend. Utilities everywhere are upgrading to smart infrastructure, and that's not stopping anytime soon.
All right, so let's put it all together. What does this all mean for the stock? Where do we go from here? Here is our official take as we look ahead to the next call.
We are initiating our coverage on Xylem with an outperform rating. And just so we're all on the same page, what that means for us is that we expect the stock to provide a total return that's greater than its sector benchmark over the next 12 months.
So here's our thesis, boiled down. Management's own guidance implies they're already targeting Q4 earnings around $1.40 per share, which is well ahead of what the street is thinking. Now look, let's be real. The stock isn't exactly cheap right now, trading near its highs. But here's the thing. We believe the exceptional quality of their execution and this clear forward momentum absolutely justifies that premium, and it warrants our outperform rating.
And as always, to be perfectly clear, this is not financial advice.